Welcome back to the Explainer, Econosite audience. Let's jump right in. Today, we're looking at a macroeconomic milestone that is literally shifting the tectonic plates of global finance. The Institute of International Finance, or IIF, just dropped some absolutely staggering new data on the sheer scale of global debt. And look, this has profound implications for global markets, for sovereign health, and ultimately for your own portfolio. We're staring at a mountain of global debt nearing a record $353 trillion. But here's the thing, that headline number, it's really only half the story. The real intrigue we found is in where this money is flowing, who exactly is borrowing it, and how it's quietly upending traditional investment strategies.
Okay, let's dive into this. Here is our roadmap for today. First, we'll look at the $353 trillion debt record. Second, we'll explore diverging global debt trajectories. Third, we'll map out shifts in emerging markets. And fourth, we'll break down the future structural fiscal pressures.
All right, let's start with Section 1, the $353 trillion debt record. $353 trillion. Just let that sink in for a second. To put that into perspective, this is the highest that number has ever been in human history. This isn't just some abstract textbook statistic. This is the fundamental baseline of the macroeconomic environment we're all navigating today. Think about it. Every single interest rate decision, every inflation report, every currency fluctuation you see in the news, it's all happening under the immense gravity of this $353 trillion figure. But, we have to look at this proportionally, right? While the absolute dollar amount is undeniably massive, the global debt-to-GDP ratio, which is basically how we measure debt against the actual economic output of the world, has actually remained broadly stable. It currently sits at 305%, which is right about where it's been since 2023. So what does this tell us? Well, it means that while debt is growing immensely, global economic output has, at least up to this point, managed to grow right alongside it to keep that overall ratio relatively steady. However, it's the momentum that's really catching everyone's attention right now. In the first quarter alone, we saw a $4.4 trillion surge. According to the IIF report, that was the fastest quarterly increase since mid-2023. It also marks the fifth straight quarterly rise. And what was the primary engine behind this massive jump? Well, it was largely driven by a significant borrowing push from Washington. Moving on to Section 2. Diverging global debt trajectories. And this brilliantly illustrates the core divergence we're seeing right now. Notice how the United States is on a trajectory where its debt-to-GDP ratio is expected to just keep rising, driven heavily by government borrowing. In fact, recent projections from the Congressional Budget Office indicate a further deterioration in the U.S. long-term fiscal outlook. Now, contrast that with the Eurozone and Japan. They are projected to follow a much more moderate path. Even with their own continued fiscal expansions, their debt ratios are remaining stable. So we've got two very different macroeconomic realities playing out at the exact same time. Now, this divergence isn't just some academic observation. It has immediate real-world market consequences. Emery Tiftik, the director at the IIF for Global Markets and Policy, put it perfectly in the report. He wrote, "These trends partly reflect diverging debt trajectories, which are increasingly influencing investor allocation decisions." Basically, when investors see the U.S. fiscal outlook deteriorating while Europe and Japan stabilize, they literally change where they park their capital. So, the crucial point is this. Investors are actively diversifying right now. The IIF notes that international demand for Japanese and European government bonds is visibly strengthening. Meanwhile, demand for U.S. Treasuries, which, let's remember, is traditionally the absolute bedrock of global safe haven assets, well, that demand remains only broadly stable since the start of the year. Capital is subtly but very surely shifting away from U.S. sovereign debt and moving toward international alternatives. But wait, there's a really fascinating exception to this U.S. headwind. While the U.S. government might be facing a bit of a plateau in international demand for its debt, U.S. corporate bond markets are absolutely booming. The catalyst? You guessed it, artificial intelligence. AI-related corporate debt issuance, combined with really strong overseas inflows, is creating a massive boom for American companies looking to raise capital. So, global investors might be a little wary of Washington's debt right now, but they are more than happy to lend to Silicon Valley. Let's transition to Section 3, shifts in emerging markets. The biggest player here, of course, is China. But the nature of their debt is pretty unique. The IIF report points to a sharp acceleration in Chinese debt at the start of the year. But, and here's the kicker, it wasn't driven directly by the central government. Instead, it was driven by Chinese non-financial corporate borrowers, which are predominantly state-owned firms. Their borrowing significantly outpaced the direct borrowing by the country's actual government. It's just a different mechanism of state-sponsored expansion.
Outside of China, emerging markets as a whole saw their debt levels rise modestly to hit a brand new record of $36.8 trillion. And this was primarily driven by government borrowing in these developing nations. What's fascinating here is that while this emerging market debt rose, debt across mature markets outside the US actually edged slightly lower.
Now, what's really interesting about this data is looking at the specific nations driving it. Notice the 5 nations recording the most extreme jumps in the first quarter: Norway, Kuwait, China, Bahrain, and Saudi Arabia. Every single one of them saw their debt-to-GDP ratios increase by more than 30 percentage points. Notice a theme there? Aside from China, these are some of the world's most significant energy-producing nations. It really highlights how deeply intertwined global energy policies are with sovereign debt issuance. Knowing what we know now, what unavoidable forces will drive future global borrowing? I mean, what guarantees that this $353 trillion mountain is only going to keep growing?
That brings us to our final section, Section 4, Future Structural Fiscal Pressures.
Let's see how this builds. The Institute of International Finance has laid out 5 unavoidable, medium to long-term structural pressures that are building on the horizon right now. First up, aging populations. Demographic realities simply mean higher healthcare and pension costs for governments. Second, rising spending on defense, especially as the global geopolitical temperature keeps rising. Third, the massive capital required for energy security and the diversification away from fossil fuels. Fourth, the absolutely urgent need for nationwide cybersecurity enhancements. And finally, as we touched on earlier, monumental AI-related capital expenditure. Here's the bottom line. Neither governments nor corporations can simply opt out of these expenses. They will literally be forced to keep borrowing to fund them. And unfortunately, current events are basically acting like lighter fluid on these structural fires. As Emre Tiftik notes in the report, the recent conflict in the Middle East is set to further intensify some of these pressures. Geopolitical instability doesn't just disrupt supply chains, right? It forces nations to rapidly accelerate their spending on defense and energy security, which inherently means accelerating their debt issuance. So we've seen how this $353 trillion global debt surge is reshaping everything from U.S. corporate bonds all the way to the sovereign debt of energy exporters. The structural pressures of tomorrow pretty much guarantee this debt is only going to rise, while the diverging policies of today show us that investors are already looking well beyond U.S. Treasuries for safety. As global structural pressures guarantee higher debt across the board, how will your portfolio adapt to the continued shift of global capital away from U.S. Treasuries?